Money FM 89.3. Best of breakfast. The U.S. Market Update with Money FM 89.3.
Good morning. Welcome to the U.S. Markets Wrap with me, Ryan Huang. As read on the screen again, as we see stocks dropping, that relief rally at one stage proving to be short-lived. The Dow Jones Industrial Average down 0.8%, dropping 320 points to 37,646. So this brings its four-day loss to more than 4,500 points. The S&P 500 also on a four-day losing streak, dropping 1.6% to 4,983, breaking below 5,000 for the first time since April 2024. And for the past 4 days, it's fallen more than 12%. And the Nasdaq Composite was the biggest loser, falling 2.2%. For more insights, we are joined by Matt Maley. He is the Chief Market Strategist for Maley Tabak. Matt, how are you doing today?
Well, I'm doing fine, but it's been a crazy market. That's for sure.
Crazy markets indeed. How do you make sense of what's going on right now? Because you've got tariffs, the first round's kicked off, and then you've got the next one coming soon. How much downside are you bracing yourself for in this current environment?
Well, I mean, the concern, on a short-term basis, the market is starting to get a little bit of washed out, but the concern is that there could still be some more weakness, even if we see a near-term bounce at some point this week. And the reason for that is that, all this uncertainty surrounding the tariff issue, but also because even before the tariff issue has wreaked all this havoc, we had problems with concerns about earnings growth and the consumer slowing down here in the U.S., and then also about how good the earnings would be from the AI phenomenon. So, and I guess the other thing is that we're about to come into another uncertain period when we start with the earnings season, which begins on Friday and runs for the next few weeks.
Yeah, it's worth noting as well, all this is being priced in before these tariffs actually have any real impact. They haven't really kicked in yet. So investors and traders trying to price in what might happen. And they've been talking up a lot about the odds of a recession, the pressure on margins, and so on. What's your outlook on growth when it comes to the impact and, of course, the potential for the tit-for-tat to go on? We've already seen China responding.
Yeah, it's certainly creating a lot more headwinds because not only are investors unsure of what's going to happen next, so are business leaders. They don't know how much they should be able to order, how many people they should hire, should they lay off people, should they add people, how much should they invest in capital expenditures, et cetera. And when those things slow down and come to a halt, that definitely creates serious headwinds for the economy. So, there's a lot of people who weren't even thinking about the possibility of a recession just 3 months ago are now saying one is very possible.
Yeah, when you look at the data coming through from the U.S. consumer and the rest of the economy, what's it telling you? Are we on the way towards a slower economy? How slow are you looking at recession?
Well, with everybody calling for, lowering their estimates now to the below 1% growth for this year, I think the odds of a recession are higher than most people. I think some people are looking for about 60% chance of a recession. I think it's more like closer to 80%. And it's just that, again, it goes back to the concern that the economy was already slowing before this tariff issue took hold. And, even if we get some relief on it quickly, it's going to be hard to avoid it. Now, again, I don't say it's a 100% chance, but the problem is the stock market is not pricing in a recession at all. In fact, it wasn't pricing in a slowdown in growth. So now that we're definitely getting, low single-digit growth, probably close to zero, even if it's slightly positive, that makes it tough for the stock market.
All right, so we've got a lot of uncertainty in the markets, a lot to try to digest. Where do investors seek safety in these days? What are the places for them to find shelter?
Yeah, that's been a problem because, some of the traditional areas that have not really been working too well, like gold. Gold worked very well at the beginning of this correction, but in the last couple of weeks or so, it's come down quite a bit. I still think that's going to become a better place to hide again. had been bullish on gold for a while, but then turned more cautious recently. But the other area, of course, is the Treasury market. Now, the last 2 days, the U.S. Treasury market has sold off. But I do think that if you stay towards the shorter end of the yield curve, in other words, in T-bills or 2-year notes or such, that's going to be a better place to hide because you can see a little bit better protection against inflation. Now, even T-bills, which are, you're actually paying you something now. 5 years ago, they weren't paying anything. And so it's a place where you can roll them over rather quickly and still keep up with inflation.
All right, so perhaps rotating towards T-bills could be a play here. Should you be cutting exposure from equities at this point because things are going down, or should you be snapping up bargains at this stage?
Well, I have been saying for the first 3 months of the year that people should be raising cash. Now, I'm going to say, maybe we could raise a little bit more cash because I do think that there could be some more weakness. But for the most part, the best thing to do is get a list of stocks you really like, and instead of trying to buy them, and also look once for whether it has pay a good dividend yield. You look at a stock like a Chevron or Pfizer. These are a good company, mature companies. They're going to be able to survive this recession, assuming we have one, and they pay you that dividend. They pay you to wait. But also think about buying them gradually. In other words, even the stocks you really like, maybe a little bit riskier stocks like an NVIDIA, which has come down quite a bit. But instead of trying to buy it all at once, buy a little bit each month for the next 5 or 6 months. That'll give you a good average price for the long-term play. All
right. You mentioned gold was one of your favorite plays. Year on year is up 27%. Year to date up 13+%. Of course, you mentioned as well, over the week it's been down 4%. What's your take on gold miners? A bit of a proxy play.
That's interesting because when the stock market goes down, all stocks go down. So even sometimes the gold miners. The great thing to look at when it comes to the gold miners, when the commodity breaks out to the upside, the gold miners tend to outperform. And we saw that earlier this year when gold broke out in January, and the gold miners outperformed the commodity in a big way. So what I'm going to be looking for right now is to see if the gold can bounce off its 50-day moving average, which is very close by it, $2,950. If it could bounce off that level and move, probably above back above 3,000, it should run nicely, and that should help the gold miners outperform. So look for that bounce in gold. It's okay to own, GLD, the gold mining ETF, but then maybe look at the GDX once you get confirmation, the GDX, which is the gold miner ETF.
All right, still a couple of ways to play the market with what's going on. And helping us out this morning is Matt Maley. He's the Chief Market Strategist for Tabak. Matt, thanks as always for your time and insights. Hope you have a great rest of the day.
You too. Thank you very much.
All right, catch up again soon. Stay Money FM 89.3.
Before acting on the information on Money FM, please consider if it's suitable for your own investment objectives, financial situation, and risk tolerance. To listen to more great interviews, download our podcasts at audio.sg or download the audio app. That's AWEDIO, audio at the App Store and Google Play.